Hi, Chair Powell. I was wondering in the SEPs you have quite a markdown to GDP from 4 to 2.8%. I'm wondering how much of that do you feel is a result of the Fed's stiffer than expected action here? You talk about monetary policy operating with a lag, but is this going to bite quicker than expected?
I don't think that's a big piece of it, actually. I think some of that is just an early assessment of the effects of spillovers from the war in Eastern Europe, which will hit our economy through a number of channels, highly uncertain. But you're looking at higher oil prices, higher commodity prices. It'll be so that we think that will weigh on GP to some extent. So that's part of what moved those assessments down. I think generally monetary policy works with a lag, so some of that would also be in there. But remember as well that 2.8% is still very strong growth. If we think that the potential growth rate of the economy is somewhere around 1.75%, 2.8% is strong economic growth. It would have been one of the strongest years, in fact, of the last expansion. So while it's lower than last year's 5.8%, it's still quite strong growth. So I would say it's quite a strong forecast.
So in that context, what would trigger you to go faster or slower on the rate hikes? Ongoing increases doesn't really tell us whether this is going to come in bigger chunks or evenly paced through the year.
Yeah, so the way we're thinking about this is that every meeting is a live meeting. And we're going to be looking at evolving conditions. And if we do conclude that it would be appropriate to move more quickly to remove accommodation, then we'll do so. I can't be perfectly specific about it, but that's certainly a possibility as we go through the year.